Joining us this morning is Oppenheimer Asset Management's Chief Investment Strategist, John Stoltzfus. John, it's great to have you back. 5,500, but you are making some changes within the index. Talk about that.
Yeah, making a few changes. The primary one is we brought utilities up from an underperform to a market perform. While its weighting is still below where we had anticipated it would go within the S&P, it's outperformed a good number of sectors here. So we brought it up to a market perform, but we still stick with our favorite sectors, our technology, consumer discretionary, which we think has been hit much too much based on the resilience of the consumer. In addition to that, yeah, we like industrials, communications, services, and financials. So we feel comfortable with this. And of course, the industrials, because this is the year we're going to see some spending, hopefully, of all that money that's been allocated to the infrastructure build out.
Right. Is the Fed an overriding factor in your playbook, or at this point, are you trying to design one that'll work whether it's higher for longer or we get a cut sooner rather than later?
You know, Carl, we've been big fans of the Fed, unlike a lot of our peers. We have felt that the Fed this cycle has been remarkably sensitive in applying its mandate. The only time it was aggressive was in 2022 when it had to raise 4 times consecutively, 75 bips at a time, the benchmark rate. But generally speaking, it's been a mix of 11 hikes and 7 pauses. And as a result of that, you know, we think the Fed is bringing this thing in so far without a recession. It may be able not to do it, may be able to do that, bring it in without a recession. And this should be good for stocks. Revenues and earnings growth, particularly earnings growth, remarkably good. You look at Q1, 8 sectors positive earnings growth, 6 of those double-digit earnings growth, only 1 of those, the Utes. And within that, by the way, with the utilities, the other thing that we're seeing is the market is getting this feeling of anticipation, at least by year end, of 1 cut or 2 cuts. And in that would take away some of the stigma of bond proxy in advance, you know, as a discount mechanism by buying Utes in here. And then the Utes also a big play in terms of AI and the electric grid, which they're likely to benefit from. But that's a longer term play. We think that's why we did get crazy and do an outperform for the year for the Utes.
We're never going back to utilities. We're only going to Utes, John.
The Utes.
What about, you know, you said the earnings growth is strong. Is it happening as, I mentioned the GDP revision for first quarter. So if GDP is weakening, labor market is weakening, and earnings growth is strengthening?
Let's see how that GDP number actually comes out as we go through the quarter. And any revisions that need to be made. But when we look at it, you know, if I take a look at where earnings have come out, you've got double-digit earnings growth in the area of 30 to 40% in areas like technology, communications, services, consumer discretionary. We don't expect a dramatic drop-off in terms of growth. If anything, the resilience in business, the consumer, and in jobs growth, even while slowing at this point in the Fed funds hike cycle, points to a healthier economy than many people are giving it credit to.